The live price for Applied Digital Corp, APLD, on the NASDAQ is currently $32.03 USD, reflecting an intraday movement of approximately minus 3.23% today. That dip, a common sight in this volatile sector, is what most eyes will focus on. But the more interesting and frankly unexpected angle lies in the institutional volume accompanying this small pullback. The market narrative, the general expectation, has been completely dominated recently by the announcement of that massive 15-year, $5 billion lease with a U.S. investment-grade hyperscaler for 200 megawatts of data center capacity, and the subsequent news of a $1.5 billion power project deal with Babcock & Wilkinson. This kind of news typically leads to a sustained run-up, and indeed, the stock has had an impressive surge over the past year, as many retail investors and self-investing enthusiasts finally felt confident in APLD's pivot away from its older crypto-centric identity towards a pure-play AI infrastructure provider. That narrative of securing huge, long-term contracted revenue is a massive expectation driver. However, the immediate reality that we are seeing in the tape, even on a day where the NASDAQ composite itself is relatively flat, is not just a modest dip, but a subtle yet consistent increase in sell-side institutional volume on the bid-ask spread, suggesting that some larger players might be taking profits after the massive run-up from the initial CoreWeave lease and the subsequent financing news from Macquarie. This is the friction between expectation and reality we need to look closer at. The market expects this stock to continue its rocket climb solely based on the contract value, but the deeper tape analysis suggests a more cautious, measured, and profit-taking disposition from institutions who bought in lower. This kind of nuanced selling is often less about a lack of faith in the company's long-term vision and more about portfolio management, rebalancing after a significant parabolic move. It challenges the common belief that simply signing a major contract instantly insulates a stock from daily price pressure. Instead, it reinforces the tactical reality that stocks must breathe, consolidate, and occasionally shed weaker hands. This is the kind of detail that differentiates professional analysis from the quick headlines you might scroll past on various investing sites, or what you'd see filtered through simplified platforms like Robinhood. The recent movement has been fundamentally tied to the company's strategic shift. For a long time, Applied Digital was known mostly in the cryptocurrency mining space, a sector notorious for its volatility and sensitivity to crypto price swings and power costs. The stock's past performance was erratic, to say the least. Now, the overwhelming market belief is that APLD is cementing its status as a core component of the AI infrastructure gold rush, positioning itself as a vital pick-and-shovel provider in a world increasingly reliant on compute-intensive workloads. The reality check, though, comes from their financial statements and the execution risk associated with such rapid, capital-intensive expansion. While revenue has grown significantly year over year, their net losses have also expanded. This is the classic high-growth dilemma: massive revenue opportunity versus massive upfront cost. The August 2025 fiscal first quarter report showed a substantial 84% revenue increase year over year to $64.2 million, which is fantastic. But it was overshadowed by a net loss attributable to common stockholders of $27.8 million. This loss figure, which is significantly down from the comparable period, is what the market is quietly digesting right now. It means the company is successfully generating top-line growth and executing on its build-out, but it's still burning capital at a clip, a necessary evil for a company moving so aggressively into a space dominated by giants. For those using an individual brokerage account to invest, it's essential to understand that every dollar of contracted revenue from the new leases won't instantly translate into net profit. There's a huge bridge of construction, fit-out, and operational expenses to cross first. The market is weighing the $11 billion in total anticipated contracted lease revenue from the Ellendale, North Dakota Polaris Forge 1 campus, which includes the initial $7 billion from the first two leases and the newer 150 megawatts CoreWeave lease, against the need for financing to complete that campus and the subsequent $3 billion Polaris Forge 2 campus. The recently secured financing, including the initial draw from the $5 billion preferred equity facility with Macquarie Asset Management and the $50 million from Macquarie Equipment Capital for Polaris Forge 2, highlights both the institutional support and the continuous need for external funding. This dependence on external capital introduces a real, tangible risk of dilution or unfavorable financing terms down the line, an internal challenge that is often obscured by the headlines of billions in contracts. When we look at the specific institutional activity, we have to recognize that the big Fidelity Investments and other major institutional holders often operate on a longer time horizon than retail traders. The most recent 13F filing showed mixed signals. Some institutions, like Hood River Capital Management, increased their positions, while BlackRock Inc. decreased theirs. The key takeaway here isn't the simple buy-sell action, but the overall increase in the number of institutional holders, suggesting that the strategic pivot to AI data centers has attracted fresh, sophisticated interest. This is a critical indicator for long-term holders. A stock like APLD, with a high beta, a figure above 6.0 in some models, will naturally see significant daily swings, much more pronounced than a blue-chip holding like Apple stock or a sector titan like Nvidia stock. The daily movements are less about the fundamental change in the business overnight, and more about the market's collective reaction to news, sector momentum, and technical trading levels. The recent rise in volume, even on down days, indicates strong liquidity and a high level of engagement from both retail and professional traders. For those managing their own portfolios, maybe using an approach seen in self-investing on platforms like Fidelity or Interactive Brokers, this volatility needs to be managed with appropriate position sizing. The expectation for APLD remains high because of the sector tailwinds, the massive, insatiable demand for high-performance computing, HPC power, for AI model training. The reality is that the stock's chart has been, and likely will continue to be, a roller coaster, as each construction milestone, financing announcement, and earnings report acts as a fresh catalyst or a point of friction. Let's break down the core business model to fully appreciate the expectation versus reality dynamic. Applied Digital's business is now fundamentally split into two main segments, the data center hosting business and the high-performance computing, HPC hosting business. The data center hosting segment, which historically served crypto mining, is being de-emphasized but still provides a foundational revenue stream. The real focus, the expectation for growth, is entirely in the HPC hosting business. This is where they design, construct, and operate data centers specifically tailored for high-power density applications like AI. Think of the massive GPU clusters needed to train and run large language models. APLD's value proposition is that they provide the infrastructure, the power, the cooling, and the physical space that the hyperscalers and AI companies, like their new major client, desperately need. This is a capital-intensive, utility-like model. The company secures land, sources massive amounts of power, and builds out these specialized facilities, which are increasingly using advanced cooling techniques like liquid cooling to handle the heat generated by systems packed with NVIDIA stock GPUs. The expectation here is that their long-term contracts, some extending 15 years, will provide predictable, recurring revenue, moving them into a kind of utility classification for the digital era. The reality, however, is that while the contract length provides confidence, the technology is moving so fast that APLD must continually upgrade and maintain its infrastructure to meet the evolving needs of its high-demand clients. They are currently betting heavily on the North Dakota sites, leveraging access to large, relatively low-cost power supplies. But this geographic concentration is also a risk. In terms of macro pressures, the stock operates under the immense gravitational pull of the wider tech sector and interest rates. Higher interest rates make the capital required for data center construction more expensive, pressuring margins and valuation multiples. This is a universal headwind that impacts everything from a major data center operator to the future prospects of Tesla stock and the lending arms of financial services companies. Furthermore, the overall sentiment around AI and the performance of companies like NVIDIA acts as a strong tide. When the AI sector is surging, APLD tends to run harder due to its high beta. When the sector pulls back, APLD tends to fall further. This is a reminder that while the company is executing on its internal strategy, it is still inextricably linked to the broader, often irrational sentiment of the market. For those interested in online investment through a diversified strategy, this stock represents a high-conviction, high-volatility pure play that should be balanced by more stable holdings, perhaps through Fidelity ETFs or a more conservative approach like the Schwab Intelligent Portfolios. The most critical catalysts moving forward will be the continued operational updates on their Polaris Forge 1 and 2 campuses.